Question 1. Suitability and ethical practices. Mr. Carter, a 55-year-old client with a moderate risk tolerance, is considering purchasing a variable annuity as part of his retirement planning. His primary financial goal is to ensure a predictable income stream once he reaches retirement age. Which of the following factors should be the most important consideration when assessing whether a variable annuity is suitable for Mr. Carter? A. The current interest rate environment and the projected rate of return from the variable subaccounts. B. Mr. Carter's desire for a fixed payout amount during his retirement. C. The level of surrender charges associated with the variable annuity. D. Mr. Carter's current health status and life expectancy. Answer A. The current interest rate environment and the projected rate of return from the variable subaccounts. Explanation. When assessing the suitability of a variable annuity for a client, it is crucial to understand the client's financial goals, risk tolerance, and the specific characteristics of the product. Since Mr. Carter is seeking a predictable income stream, it is important to consider the risk and return characteristics of the variable subaccounts that could affect the future value of the annuity. Variable annuities expose the client to market fluctuations, which directly impacts their potential returns. Thus, understanding the performance of the subaccounts and how they align with his long-term goals is vital. Option B is incorrect because a variable annuity does not provide a guaranteed fixed payout amount. The payouts depend on the performance of the underlying investments. Option C is incorrect as while surrender charges are important, they do not address Mr. Carter's main goal of securing a predictable income stream. Option D is irrelevant in this context, as the decision to purchase a variable annuity is based on financial goals and risk tolerance, not health status or life expectancy. Question 2. Annuity payout options. Which of the following annuity payout options offers the most flexibility in terms of providing income for both the annuitant and their beneficiary after death, while also ensuring that the annuitant will receive payments for life? A. Single life annuity with period certain. B. Joint and survivor annuity. C. Life annuity with refund. D. Life annuity with period certain. Answer. B. Joint and survivor annuity. Explanation. A joint and survivor annuity ensures that both the annuitant and their beneficiary, typically a spouse, receive income for life. This option provides lifetime income for both individuals, with the payments continuing to the surviving spouse after the annuitant's death. Option A is incorrect because a single life annuity with period certain provides income for the annuitant's life, but only for a specified period. If the annuitant dies before the period expires, the beneficiary receives the remaining payments. Option C is incorrect because a life annuity with refund ensures that the annuitant will receive payments for life, but if the annuitant dies before receiving the total premium, the beneficiary is refunded the difference. However, this does not provide the same level of lifetime income for both the annuitant and the beneficiary. Option D is incorrect because while a life annuity with period certain provides payments for the annuitant's lifetime with a guaranteed period, the beneficiary may not receive ongoing payments if the annuitant dies after the period ends. Question 3. Scenario-based question. Types of annuities. Mr. Johnson, a 60-year-old individual, is looking to invest in an annuity to ensure a steady income stream after retirement, but he is also concerned about market fluctuations. He is particularly interested in an annuity that provides both a guaranteed minimum income and exposure to stock market performance. Which type of annuity should Mr. Johnson consider? A. Fixed annuity. B. Immediate annuity. C. Indexed annuity. D. Deferred annuity. Answer. C. Indexed annuity. Explanation. An indexed annuity is a suitable option for Mr. Johnson because it offers a guaranteed minimum income through a fixed base rate, while also providing the potential for higher returns based on the performance of a stock market index, such as the S&P 500. This annuity balances the need for stability with the opportunity to benefit from market growth, addressing Mr. Johnson's concern about market fluctuations. Option A is incorrect because a fixed annuity provides a guaranteed, predictable income stream but does not offer any exposure to stock market performance or the potential for higher returns. Option B is incorrect because an immediate annuity starts paying out immediately after purchase and does not offer market-linked returns or the opportunity for income growth. Option D is incorrect as a deferred annuity allows the accumulation of funds before payouts begin, but it does not necessarily provide exposure to market performance. While it can be designed to offer market-linked returns, the focus here is on the time until payouts start, which does not directly address Mr. Johnson's desire for a combination of guaranteed income and market exposure. Question 4. Annuity sales and marketing practices. which of the following statements is true regarding the marketing of annuities under Vermont's consumer protection laws? A. All marketing materials must include a clear statement that annuities are guaranteed to earn a fixed rate of return. B. Annuity advertisements must disclose all fees, including surrender charges and management fees, to avoid misrepresentation. C. Marketing materials for variable annuities can exaggerate the potential for high returns as long as a disclaimer is included. D. It is acceptable to omit details about the risk of market fluctuations in marketing materials for fixed annuities. Answer: B. Annuity advertisements must disclose all fees, including surrender charges and management fees, to avoid misrepresentation. Explanation: Vermont's consumer protection laws require full and transparent disclosures in all annuity marketing materials. This includes providing clear information about all associated fees, such as surrender charges and management fees, to ensure that potential buyers are well informed. Misrepresentation of annuity features or risks, including omitting fee details, is prohibited to protect consumers. Option A is incorrect because not all annuities offer a fixed rate of return, especially variable annuities, and marketing materials must not make misleading claims. Option C is incorrect because exaggerating potential returns, even with a disclaimer, can still be considered misleading and is prohibited under ethical marketing practices. Option D is incorrect because even fixed annuities, while offering guaranteed returns, must disclose all relevant risks and charges in the marketing materials. Question 5. Annuity product features: which of the following is most likely to impact the returns of a variable annuity? A. The type of payout option chosen by the annuitant. B. The performance of the sub-accounts linked to the annuity. C. The insurer's general expenses associated with managing the annuity. D. The age of the annuitant at the time of purchase. Answer: B. The performance of the sub-accounts linked to the annuity. Explanation: the returns of a variable annuity are primarily influenced by the performance of the underlying sub-accounts, which can include stocks, bonds, or mutual funds. The annuitant's returns are tied to the performance of these investment options, which can fluctuate based on market conditions. Option A is incorrect because while the choice of payout option affects the distribution structure, it does not impact the growth potential of the annuity. Option C is incorrect because the insurer's administrative expenses impact the net returns, but it is the market performance of the sub-accounts that primarily drives the returns. Option D is irrelevant because the age of the annuitant affects the payout amounts in life annuities, but does not directly influence the return from the variable sub-accounts. Question 6. Market value adjustment in annuities. A market value adjustment (MVA) in an annuity contract allows A. the insurance company to adjust the annuity's payout amount based on market interest rates. B. the annuitant to transfer funds between various accounts without penalty. C. the annuity to be converted into a life insurance policy. D. the annuitant to withdraw all funds tax-free. Answer A. The insurance company to adjust the annuity's payout amount based on market interest rates. Explanation: an MVA feature allows the insurance company to adjust the surrender value of an annuity if funds are withdrawn before maturity, reflecting current interest rate conditions. Question 7. Regulatory environment and legal considerations under Vermont state law. Which of the following would most likely be considered a violation of the suitability requirements when recommending an annuity? A. Recommending a fixed annuity to retirees seeking guaranteed income and capital preservation. B. Recommending a variable annuity to a client in their 30s with a high-risk tolerance looking for market growth. C. Recommending a deferred annuity with a 10-year accumulation period for a 65-year-old client who plans to retire in 3 years. D. Recommending a life annuity with a period certain to a client who is concerned about leaving a legacy for their heirs. Answer: C. Recommending a deferred annuity with a 10-year accumulation period for a 65-year-old client who plans to retire in 3 years. Explanation: the suitability requirements under Vermont law dictate that financial products must be recommended based on a client's financial goals, risk tolerance, and time horizon. Recommending a deferred annuity with a long accumulation period for a client who plans to retire soon could be considered unsuitable. A 65-year-old client who plans to retire in 3 years might need more immediate access to income rather than a product with a 10-year deferral period. Option A is correct because a fixed annuity is suitable for a retiree seeking guaranteed income and capital preservation. Option B is correct because recommending a variable annuity for a younger client with a high-risk tolerance aligns with the individual's financial goals and risk profile. Option D is also appropriate, as a life annuity with a period certain provides income for life while still addressing the client's concerns about leaving a legacy. Question 8. Annuities and retirement planning. Which of the following is true about the role of annuities in retirement planning? A. Annuities are typically used to provide a lump sum payment upon retirement. B. Fixed annuities are the most suitable choice for individuals who seek exposure to stock market growth. C. Annuities can provide predictable income streams which help manage longevity risk in retirement. D. Annuities are not subject to required minimum distribution (RMDS) once the contract is in payout phase. Answer: C. Annuities can provide predictable income streams which help manage longevity risk in retirement. Explanation: Annuities, especially life and income annuities, are valuable tools for managing longevity risk, which is the risk of outliving one's assets. They provide predictable income streams for the duration of the annuitant's life, ensuring financial security throughout retirement. Option A is incorrect, because annuities typically provide periodic payments, not lump sum payments, especially for those seeking retirement income. Option B is incorrect, because fixed annuities do not offer exposure to stock market growth. They provide a fixed return, unlike variable annuities that invest in market-based portfolios. Option D is incorrect, because annuities are subject to RMDS under IRS rules once the annuitant reaches the required age, typically 72, even during the payout phase. Question 9. Risk management and annuities. Which of the following best describes how inflation risk can be managed with an annuity? A. By selecting an annuity with a guaranteed minimum income rider that adjusts payouts for inflation. B. By investing in a variable annuity with high exposure to stocks. C. By choosing a fixed annuity that guarantees income for life, regardless of inflation. D. By selecting a deferred annuity with a long accumulation period to offset future inflation. Answer A. By selecting an annuity with a guaranteed minimum income rider that adjusts payouts for inflation. Explanation: Inflation risk, or the risk that the purchasing power of fixed income will decrease over time due to rising prices, can be mitigated by choosing annuities with riders that adjust the payout amount based on inflation. These riders, such as the inflation protection rider, ensure that payouts increase over time to keep pace with inflation. Option B is incorrect, because investing in a variable annuity with stocks does not directly address inflation risk. It exposes the investor to market fluctuations. Option C is incorrect, because while fixed annuities provide stable income, they do not account for inflation, which may erode the value of fixed payouts over time. Option D is incorrect, because a deferred annuity with a long accumulation period may not offset inflation if the payouts are not adjusted for inflation. Question 10. Annuity contracts. Which of the following is a key feature of an annuity contract's free look period under Vermont law? A. The annuitant can change the payment frequency during the free look period without penalty. B. The annuitant can cancel the contract and receive a full refund of all premiums paid, minus any administrative fees. C. The free look period allows the annuitant to withdraw up to 50% of the premiums paid without any penalties. D. The annuitant can cancel the contract and receive a refund of premiums paid plus any earned interest without any penalties. Answer: B. The annuitant can cancel the contract and receive a full refund of all premiums paid, minus any administrative fees. Explanation: Under Vermont law, the free look period allows the annuitant to cancel the annuity contract within a specified period, typically 10 to 30 days depending on the contract, and receive a full refund of all premiums paid, minus any applicable administrative fees or other charges. This period provides the annuitant an opportunity to review the contract and ensure it meets their needs without financial penalty. Option A is incorrect, because the free look period does not allow changes to the payment frequency. It only allows cancellation and refund. Option C is incorrect, because the free look period does not allow for penalty-free withdrawals of premiums. It only allows for cancellation and refund of premiums. Option D is incorrect, because the refund during the free look period typically includes only the premiums paid and not any interest or investment gains. Question 11. Annuity contract termination. Under Vermont law, an annuitant can generally terminate an annuity contract and receive a refund during which of the following periods? A. The first 10 days after the contract's issuance. B. The first 30 days after the contract's issuance. C. The first 60 days after the contract's issuance. D. The first 120 days after the contract's issuance. Answer: B. The first 30 days after the contract's issuance. Explanation: Under Vermont law, most annuity contracts provide a 30-day free-look period during which the annuitant can cancel the contract and receive a full refund of the premiums paid, minus any administrative fees. Option A is incorrect because the free-look period is typically 30 days, not 10. Option C is incorrect because the standard period is 30 days, not 60. Option D is incorrect as the free-look period generally does not extend up to 120 days. Question 12. Tax treatment of annuities. Which of the following statements regarding the taxation of annuities under Vermont law is correct? A. The premiums paid into an annuity are tax deductible at the time of contribution. B. The earnings within an annuity are subject to income tax only when they are withdrawn or paid out. C. Annuities purchased with after-tax dollars are taxed at a lower rate than traditional retirement accounts. D. Annuity payouts are never subject to state income tax in Vermont. Answer B. The earnings within an annuity are subject to income tax only when they are withdrawn or paid out. Explanation. In Vermont, like most states, the earnings within an annuity grow tax deferred until they are withdrawn or paid out. At that point, the earnings are taxed as ordinary income. Option A is incorrect because annuity premiums are generally not tax deductible. Option C is incorrect because annuity tax rates are typically similar to those of other retirement accounts, not necessarily lower. Option D is incorrect because annuity payouts are subject to both federal and state income tax. Question 13. Retirement planning and annuities. Which of the following would be a primary reason for an individual to consider purchasing an annuity as part of their retirement plan under Vermont law? A. To reduce their overall tax burden in retirement. B. To provide a guaranteed stream of income for life, mitigating the risk of outliving their savings. C. To receive immediate access to a lump sum of money without penalties. D. To invest in high-risk, high-return financial instruments. Answer B. To provide a guaranteed stream of income for life, mitigating the risk of outliving their savings. Explanation. Annuities are often purchased as part of a retirement strategy to ensure that the annuitant has a guaranteed stream of income for life, which helps mitigate the risk of outliving their savings. Option A is incorrect because annuities do not necessarily provide tax relief in retirement. Option C is incorrect because annuities are designed to provide income over time, not to offer lump sum withdrawals without penalties. Option D is incorrect because annuities generally focus on stability and guaranteed returns, not high-risk investments. Question 14. Types of annuities. Which type of annuity contract typically provides the annuitant with guaranteed fixed payments regardless of market fluctuations? A. Variable annuity. B. Fixed annuity. C. Equity indexed annuity. D. Immediate annuity. Answer B. Fixed annuity. Explanation. Fixed annuities provide guaranteed fixed payments over time, offering stability and predictability for the annuitant. Variable and equity indexed annuities are influenced by market performance, and immediate annuities refer to the timing of payouts rather than the payment type. Question 15. Annuity beneficiary designations. Which of the following is true regarding beneficiary designations for an annuity contract? A. Beneficiary designations can be changed at any time by the annuitant even after annuity payments begin. B. Beneficiaries cannot be changed after the contract is issued. C. Beneficiaries receive only the initial premium paid if the annuitant dies. D. Beneficiary designations are permanent and cannot be altered without court approval. Answer A. Beneficiary designations can be changed at any time by the annuitant, even after annuity payments begin. Explanation. In most annuity contracts, the annuitant can change beneficiaries at any time, even after payments have started. Beneficiaries receive the death benefit if the annuitant dies before payouts are complete. Question 16. Tax penalties for early withdrawal. Under federal tax rules applicable in Vermont, an early withdrawal from an annuity by someone under age 591 may result in A. No penalties if the withdrawal is for personal use. B. A 20% tax penalty in addition to income tax. C. A 10% tax penalty in addition to income tax on the withdrawn amount. D. Complete tax exemption on the withdrawn amount. Answer C. A 10% tax penalty in addition to income tax on the withdrawn amount. Explanation. Withdrawals made from an annuity by individuals under 591 were generally subject to a 10% tax penalty, along with income tax on the amount withdrawn. Question 17. Annuity suitability requirements. Which of the following best describes a primary goal of suitability requirements for annuity contracts in Vermont? A. To ensure insurers maximize profits on each annuity sale. B. To ensure that annuity products are suitable based on the client's financial situation and goals. C. To allow agents to recommend any annuity products they choose. D. To limit the sale of annuities to individuals over the age of 65. Answer: B. To ensure that annuity products are suitable based on the client's financial situation and goals. Explanation: suitability requirements are designed to protect clients by ensuring that agents recommend products aligned with the client's financial needs, objectives, and risk tolerance. Question 18. Accumulation phase of an annuity. What happens during the accumulation phase of a deferred annuity? A. The annuitant receives periodic income payments. B. Premiums are paid into the annuity and earnings accumulate on a tax-deferred basis. C. The annuity contract automatically terminates. D. Beneficiaries receive the death benefit if the annuitant dies. Answer: B. Premiums are paid into the annuity and earnings accumulate on a tax-deferred basis. Explanation: in the accumulation phase, the annuitant pays premiums into the annuity and earnings accumulate tax-deferred until withdrawals begin in the payout phase. Question 19. Death benefit in annuities. If an annuitant dies during the accumulation phase, what usually happens to the value of the annuity? A. It is forfeited to the insurance company. B. It passes to the annuitant's estate automatically. C. The beneficiary receives the death benefit, which may include premiums paid and accumulated earnings. D. The contract is cancelled without any payout to beneficiaries. Answer: C. The beneficiary receives the death benefit, which may include premiums paid and accumulated earnings. Explanation: in most cases, if the annuitant dies during the accumulation phase, the death benefit is paid to the named beneficiary, often including premiums paid and any accrued interest. Question 20. Annuitization options. Which annuitization option provides the annuitant with payments for life but does not leave a benefit for beneficiaries? A. Life with period certain. B. Joint and survivor annuity. C. Life only. D. Installment refund. Answer: C. Life only. Explanation: the life only annuitization option provides payments for the lifetime of the annuitant but leaves no residual benefit for beneficiaries upon the annuitant's death. Question 21. Partial withdrawals from deferred annuities under Vermont law. Which of the following is true regarding partial withdrawals from deferred annuities? A. Partial withdrawals are generally subject to surrender charges if made within the surrender period. B. Partial withdrawals are not allowed under any circumstances. C. Partial withdrawals automatically cancel the contract. D. Partial withdrawals are always tax-free. Answer: A. Partial withdrawals are generally subject to surrender charges if made within the surrender period. Explanation: in deferred annuities, partial withdrawals can often be made, but if they are done within the surrender period, they are usually subject to surrender charges. Question 22. Tax-deferred status of annuities. Which statement accurately describes the tax-deferred nature of annuities? A. Annuities provide tax-free growth on invested premiums. B. Taxes are only paid on the initial premium when purchasing an annuity. C. Taxes on earnings within an annuity are deferred until withdrawal, providing tax deferral benefits. D. Annuities are fully taxable each year on all accumulated earnings. Answer: C. Taxes on earnings within an annuity are deferred until withdrawal, providing tax deferral benefits. Explanation: annuities grow on a tax-deferred basis, meaning taxes on earnings are postponed until withdrawals where distributions are made. Question 23. Inflation protection rider. The primary purpose of an inflation protection rider in an annuity contract is to A. Increase the death benefit payable to beneficiaries. B. Increase the monthly annuity payout over time to keep up with inflation. C. Allow for tax-free withdrawals. D. Guarantee a minimum rate of return regardless of market conditions. Answer: B. Increase the monthly annuity payout over time to keep up with inflation. Explanation: the inflation protection rider increases annuity payments to help the annuitant's income keep pace with inflation, preserving purchasing power over time. Question 24. Immediate annuity payouts. An immediate annuity provides income payouts starting A. Immediately upon reaching age 65. B. Upon the death of the annuitant. C. Within 1 year of the initial premium payment. D. Only after a 10-year accumulation period. Answer: C. Within 1 year of the initial premium payment. Explanation: immediate annuities begin payouts within 1 year after the initial premium is paid, providing no immediate income to the annuitant. Question 25. Deferred annuities and surrender periods. In Vermont, a deferred annuity contract surrender period typically refers to a. the time during which the annuitant can surrender the policy without any penalties, b. the period during which surrender charges apply if the annuitant withdraws funds, c. the time frame within which an annuity must be converted to a life insurance policy, d. the period after which all withdrawals are tax-free. Answer: B. The period during which surrender charges apply if the annuitant withdraws funds. Explanation: the surrender period is the time during which an annuitant faces penalties, known as surrender charges, if they withdraw funds early from a deferred annuity. Question 26. Guaranteed minimum withdrawal benefit. The guaranteed minimum withdrawal benefit rider in an annuity allows the annuitant to a. withdraw a set minimum amount annually regardless of account performance, b. convert the annuity into a life insurance policy without penalty, c. transfer the annuity to another person without any tax consequences, d. receive tax-free withdrawals for medical expenses. Answer: A. Withdraw a set minimum amount annually regardless of account performance. Explanation: a GMWB rider allows the annuitant to withdraw a minimum guaranteed amount each year, even if the account value declines due to market performance. Question 27. Non-forfeiture benefit requirement. Under Vermont regulations, non-forfeiture benefits in an annuity contract provide that a. the annuitant forfeits all premiums paid if they cancel the contract, b. the annuitant receives a minimum guaranteed amount or paid-up benefits if the contract is surrendered early, c. the insurance company reserves the right to deny all withdrawals, d. the annuitant must pay a penalty for cancelling the annuity within the first year. Answer: B. The annuitant receives a minimum guaranteed amount or paid-up benefits if the contract is surrendered early. Explanation: non-forfeiture benefits ensure the annuitants who surrender the policy will receive some minimum value or benefit, preventing a total loss of invested funds. Question 20. Death benefit options. Which of the following describes a return of premium? Death benefit option in an annuity contract. A. It refunds all paid premiums if the annuitant dies before payouts begin. B. It provides no benefit to beneficiaries. C. It guarantees that beneficiaries receive at least double the premium amount. D. That only applies to immediate annuities. Answer: A. It refunds all paid premiums if the annuitant dies before payouts begin. Explanation: a return of premium death benefit option refunds the total premiums paid to beneficiaries if the annuitant dies before the start of annuity payments. Question 29. Vermont law on annuity replacement. Under Vermont law, when replacing an existing annuity, agents must a. disclose only the benefits of the new annuity, b. complete a suitability assessment and provide a replacement notice, c. offer a 30-day free look period on the new annuity, d. transfer all surrender charges to the new annuity. Answer: B. Complete a suitability assessment and provide a replacement notice. Explanation: agents are required by Vermont law to conduct a suitability assessment and issue a replacement notice to ensure the replacement is in the best interest of the annuitant. Question 30. Qualified versus non-qualified annuities. A qualified annuity differs from a non-qualified annuity primarily in that a. it is funded with pre-tax dollars, typically through retirement accounts, b. it offers higher interest rates, c. it is exempt from surrender charges, d. it allows unlimited tax-free withdrawals. Answer: A. It is funded with pre-tax dollars, typically through retirement accounts. Explanation: qualified annuities are funded with pre-tax dollars, often through retirement accounts, meaning taxes are deferred until withdrawals, while non-qualified annuities are funded with post-tax dollars.